Today's video is episode 2 of how to think like an institutional investor, where I'm trying to teach not only myself, but you guys as well, how to think like an institutional investor in the cryptocurrency space so that when institutional money makes its way into the market, we've adapted our portfolios suitably. That's the aim of the series, and in today's video we're going to be talking about the big coins, the top 10, top 20, top 25 coins in the market. If you've missed anything in this series so far, click in the top right now and you'll see the other videos in the series. But if you're sticking with me, we're going to be talking today about the top coins and which could potentially be favored by the institutional investors. Remember that nothing in this channel or on this video is financial advice. I'm going to pop up the rest here. Please pause the video and read the full disclaimer now. So the big question on the minds of everyone who is trying to get ahead of the market right now is, where will the institutional money go when it enters the market? But personally, I believe there's going to most likely be two locations. Number one, things like pension funds may potentially directly invest into the markets themselves and have their coins held by a custody holder. These coins are most likely going to be the top 25 coins we're talking about today. And category number 2, I believe many funds are going to invest into VC firms and crypto funds who are specifically investing into the cryptocurrency market. These firms tend to invest mostly into ICOs. When I say ICOs, I don't mean through the main sale like us guys. I'm talking about they meet projects well in advance and they give them some of the seed fundraising or receive a large portion of tokens in return. The overall message then is that I believe effectively the institutional money is probably going to go to two locations. Number one, the big established coins in the market, and this is probably going to be 90 to 95% of that institutional money. And maybe 5 to 10% is going to be invested into the VC firms or crypto funds, and as a result, effectively into upcoming ICOs. That's where I believe that the distribution of funds is going to be. And obviously, remember, this is just my personal opinion. So why is it then that if I believe 90 to 95% of those funds will go to the big established coins, that I'm only dedicating one video to this? The reason is that in this series, I'm going to be breaking down the aspects which I believe a crypto project must have in order for institutional money to consider them as a potential investment opportunity. In the case of the big established coins, just about all of them are going to be passing this test. For example, having a strong team is the foundation for any cryptocurrency. If you look at the top 25 coins, it's fair to say the vast majority of them have some very, very good teams. So that is why there's only one video specific to the big coins, even though I believe the majority of the money will go to these big established coins. Don't take me only making one video specifically about them as an indication that I don't believe that's where the money's gonna go. It's simply because there isn't as much to say about this topic. Now let's talk about the do's and the don'ts, the coins which I might potentially avoid and the coins which look very interesting as an investment opportunity. Let's first start with the coins I'm going to avoid. Sadly, number one is privacy coins. If you've been following this channel, I don't talk about privacy coins that much because honestly, they're not my area of specialty, but I'm a big fan of them because they are some of the few cryptocurrencies which are actually being used in the real world. The problem is with regulations, I can't imagine something like a pension fund wanting to take the risk of investing into a cryptocurrency where the majority of the use may be for things like the dark web. That's why I believe big institutional money may not be such a big fan of privacy coins. Number 2, I'm just going to outright say it, it's Ripple. I don't really want to make specific comments about coins, but I can't see institutional money being a big fan of XRP. Now, let me explain this because that may sound a bit confusing. Ripple is designed for big financial institutions, so why wouldn't financial institutions see this as a great investment opportunity? It's because XRP and Ripple are entirely different. Ripple is a fintech company, and I believe they're fantastic. If I was investing into Ripple directly, I would definitely invest into that company. The problem is when you're buying the XRP token, you're not investing into Ripple. You're simply buying the XRP token. So you have to question, what does that token actually represent? What's the real use case for it? Theoretically, it can make Ripple's solution for banks ever so slightly better. I was listening to a podcast recently, it was either Unchained or Unconfirmed by Laura Shin, always fantastic. She had a couple of guests on and they basically said that by using XRP, it increases the efficiency of banks by 2 basis points. It has a very, very small effect. But that's not even taking into account the volatility of XRP. When you do, using XRP is probably actually negative for banks. So that's why I believe Ripple, fantastic. XRP, not so much. And that's why I wouldn't personally invest into XRP. And I think institutional money is very smart as well and is probably going to see that XRP itself isn't really worth very much. To give you guys a comparison, it's really quite hilarious. XRP is currently valued at $25 billion as a market cap. Ripple raised money a while ago at a valuation of 400 million. That's 25 billion for XRP tokens and 400 million for Ripple. In other words, 50 times the valuation, slightly over in fact. That is absolutely crazy in my eyes. I can't see how XRP could possibly be worth so much more than Ripple itself. So I think the smart money, as they coin it, is not going to be a fan of Ripple. Point number 3, I think they're probably going to avoid forks which don't have a large backing. So we all know that Bitcoin and Ethereum have had some famous forks in the past. I believe Bitcoin Cash may potentially be the only exception to this. And before I get comments about that, wait for the explanation. I will explain that in the section in a second, why I think they will invest into Bitcoin Cash. What I want to focus here on though is that I don't think that coins like Bitcoin Private, Bitcoin Diamond, Bitcoin Unicorn, or any other name you want to give it, are really going to be popular with financial institutions because a lot of them have really just piggybacked on the name of Bitcoin. I don't believe institutions are really going to fall for that. And the fourth and final one are coins which intentionally hype up their project. I'm not going to name names, but we all know the types of projects I'm talking about. These are the types of projects that make an announcement on Twitter that they're going to be making an announcement next Thursday, for an announcement the following Wednesday, for an announcement on June 2019. You don't need to make an announcement for another announcement. It's not Inception.
How could I ever acquire enough detail to make them think that it's reality?
Have you ever had a dream that you want him to do you so much you could do anything?
So projects like that which intentionally hype up themselves, can't necessarily see them doing so well, particularly if they are theoretically overvalued because they've hyped up themselves so much. I believe smart money or institutional money is going to start valuing fundamentals much more so than hype. Retail investors, people like you and me, factor in hype a lot more than they potentially will. So projects which have only climbed very high because of hype are especially probably going to do badly, as institutional investors don't really care about that bullshit. Rule number 1, I would say that institutional money is probably going to find its way to the very top of the market. So when I mentioned before, maybe the top 25 coins, I think you could narrow that down much more. And most of the money is going to go to the very top, and in particular to Bitcoin. Why is this? It's because institutions build their portfolios with a very mathematical, formulaic approach. If you guys remember from the last video, I was basically saying that I believe a lot of pension funds and other funds will add cryptocurrencies to their portfolios simply because it improves the Sharpe ratio of the project, the risk adjusted return, the risk versus reward. So when it comes to things like that, what you want to pick is the least volatile of all of the coins. The higher the volatility, the higher the risk. So they want to go with potentially a lower volatility coin. The lowest volatility coins are the ones at the very, very top, and in particular Bitcoin. Rule number 2, it's the infrastructure coins. There's a whole thesis called the Fat Protocol thesis. I'm not going to go into detail now. I've been meaning to make a video for so long about it. But the idea is the majority of value in the cryptocurrency ecosystem is going to flow back to the protocol layer of which things are built on top. So I'm talking about Ethereum, EOS, Cardano, Neo, Zilliqa. All of these types of projects are the foundation layer, and the majority of value is going to flow back to them as a result. So I think infrastructure projects are going to be very, very popular. Rule number 3, and this relates to infrastructure projects, I believe it's the ones which are focused more on speed, scalability, and business applications which are going to be successful. And you might be thinking, well, what have they given up? The key word, and it's going to be contentious, it's decentralization. I believe that in the crypto space, people value decentralization very highly. In the regular world, which is the vast majority of people, they don't even know about decentralization. So how are they going to value it highly? They do know about speed, scalability, and business applications though, which is why I think it's going to be very, very important for them to have these things. They're not going to care so much whether a cryptocurrency is truly decentralized. If it's incredibly slow and the application built on top doesn't work properly, they're not going to care. What they want is applications that work very fast. So blockchains which focus on decentralization, instead of being able to be used for business applications, I can't see them necessarily being as popular in the eyes of the institutional investors. Obviously, if a cryptocurrency is able to maintain decentralization and do all of these things, then that is potentially the best one out there. All I'm saying is, I don't believe that decentralization is going to be as important as we personally think it is, because to people on the outside world, they don't even know about it, so why would they care about it that much? If you liked the video, make sure to give it a thumbs up, and if you haven't already subscribed, you might want to hit that subscription button, because if you enjoyed this video, if you made it this far in the video, you must have enjoyed it, and I've got a lot more content coming out just like this, particularly with this series, because this is just episode 2 of the Think Like an Institutional Investor series. We've got several more episodes to go.